Recording studio, everybody is ready. Please start our hearing. 5, 4, 3, 2, 1. The hearing will come to order. This is a hearing, it's a hybrid hearing, meaning that some of our commissioners are appearing in person and witnesses will testify remotely. Before I begin, let me offer a few video conferencing reminders. Once before you start speaking, there will be a slight delay before you're displayed on the screen. To minimize background noise, please click the mute button until your turn to speak or to ask a question. If there's a technology issue, we will move to the next speaker until it's resolved. You should all have one box on your screens labeled clock to show you how much time is remaining. All members and witnesses need to be especially mindful of the 5-minute clock. At 30 seconds remaining, I'll gently tap the gavel to remind members that their time has almost expired. To simplify the speaking order process, the Commission has decided to order ourselves alphabetically. With that, welcome to this virtual hearing convened by the Congressional Oversight Commission. Pursuant to Section 4020 of Title IV, subtitle the CARES Act, the Commission must conduct oversight of the $500 billion authorized for the Exchange Stabilization Fund. As a part of our oversight work, the Commission has decided to hold this hearing today, which will examine the Main Street lending facilities. The Federal Reserve established the Main Street lending program to support lending to small and medium-sized businesses and nonprofit organizations that were in sound financial condition before the onset of the COVID-19 pandemic. The program operates through 5 facilities, which we will learn more about this morning. The program is being administered by the Federal Reserve Bank of Boston. Today's hearing will have 2 panels. President Eric Rosengren, President and Chief Executive Officer of the Federal Reserve Bank of Boston, will testify during the first panel, and the second panel will include industry participants. In the absence of a chair, the commissioners have agreed to each have 1 minute of opening remarks. I'll now recognize myself for an opening statement. Our Commission is pleased to convene this hearing of the Main Street Lending Program. Thank you, our witnesses, for lending your expertise today. I believe this is an extremely timely and important discussion. I also commend my fellow commissioners. Together, we've worked in a bipartisan, bicameral way to release 3 reports and organize this inaugural hearing. I'd also like to thank our personal staffs for their diligence in this area, particularly in the absence of a chair. And on behalf of all commissioners, I welcome our new Chief Clerk, Amber Vinson, and thank you for the U.S. Senate for these facilities today. Findings from today's hearing will be reflected in our next report. The Main Street Lending Program term sheet was released on April 9th and finally became operational on July 6th. Leading to its implementation, the program generated significant interest and engagement. However, in the months since the program's been available, $95 million of the $600 billion allocated has been loaned to eligible businesses. I hope we find answers today that will help explain why it took 3 months to stand up the program and what, if anything, needs to be done to alter the program to expand the universe of eligible borrowers. I yield back, and I now recognize Commissioner Ramamurthy for 1 minute.
Thank you, Mr. Chairman, and thank you to each of the witnesses appearing today. 4 months ago, Congress gave the Treasury Department $500 billion to stabilize the economy. The Treasury quickly pledged $75 billion of those dollars to the Federal Reserve's Main Street lending program for small and mid-sized companies. After taking 3 months to set up the program, the Fed has now been operating it for about a month. In that time, it has supported only 18 loans for a total of $104 million. That is 0.017% of the $600 billion lending capacity that the Fed touted for the program in April. While all this money has been sitting on the sidelines, tens of thousands of businesses have permanently closed and millions of Americans have lost their jobs. By any measure, the Main Street program has been a failure. My goal today is to figure out why the program has failed and how to fix it quickly before more Americans lose their jobs and more good businesses have to shut their doors. Thank you, Mr. Chairman.
Thank you, Commissioner. Thank you, Commissioner. Now recognize Congresswoman Shalala for 1 minute.
Thank you. Good morning. I'd like to thank our witnesses for being here today. I represent Florida's 27th Congressional District, which includes most of Miami-Dade County. COVID-19 is out of control in my district. We have a raging community spread. As a result, we have a financial disaster. with 50% of businesses laying off workers and others going bankrupt. In South Florida, our economy is heavily reliant on tourism. Actually, we're reliant on crowds. Unlike big businesses that can rely on capital markets for funding, small and mid-sized businesses are more susceptible to being permanently shut down. Recognizing this, we approved funding in the CARES Act in March to support up to $600 billion in lending to these businesses. However, while some Florida businesses have benefited from the Main Street loans, what has been accomplished to date is simply not enough. We all agree that these businesses need help to survive the crisis, and I'm here today to understand why the money has not been deployed and what the impact has been on workers. I yield back.
Thank you, Congresswoman. I now recognize Senator Toomey for 1 minute.
Thank you very much, Mr. Chairman, and I also want to thank all the witnesses for participating in this hearing today. Look, I think the big questions that I'm looking forward to learning about is certainly why relatively few borrowers have participated in this program, why it appears not to have a tremendous amount of demand. I want to understand whether through this program banks are likely to originate loans that they would not otherwise engage in anyway. And at some point, we need to have a discussion about the fact that we're in a different place than we were when we first designed these programs back in March. We intended, at least I did as one of the negotiators of this legislation, intended to provide liquidity so that business could survive what we hoped would be a very brief, although we knew would be a severe downturn. Now we have the prospects of possibly excess capacity in a number of industries that could persist for some time. That is a new and different challenge. So I look forward to exploring all of these, and again, want to thank the witnesses for joining us.
Thank you, Senator Toomey. All commissioners' statements will be added to the hearing record. We're fortunate today to have 5 witnesses appearing and appreciate their time. President Rosengren is the president and CEO of the Federal Reserve Bank of Boston, one of the 12 regional Federal Reserve banks. Dr. Rosengren is a participant in the Federal Open Market Committee, the monetary policy-making arm of the United States. As CEO, he leads the Boston Fed's work, which includes economic research and analysis, banking supervision and financial stability efforts, community economic development activities, and a wide range of payments, technology, and finance initiatives. Ms. Lauren Anderson serves as the Senior Vice President and Associate General Counsel of the Bank Policy Institute. In this role, she oversees the BPI's advocacy across a range of domestic and international issues. She brings with her over a decade of experience in financial regulation and resolution oversight, most recently serving as the Senior Advisor at the Bank of England, and before joining the Bank of England, served as Special Advisor to the Deputy of Policy at our FDIC. Mr. Tom Bond serves as the Chief Executive Officer of the Association for Corporate Growth. ACG serves 90,000 investors, executives, lenders, and advisors to the growing middle market set of companies. Prior to joining ACG in December 2019, Mr. Bond served as CEO of the North American Veterinary Community, where he oversaw unprecedented growth. Mr. Vince Foster serves as the Executive Chairman of the Main Street Capital Corporation, a position he's held since November of 2018. Mr. Foster previously served as Main Street CEO from 2007 until November of 2018, and served as Main Street's president from 2012 to 2015. He also has been a member of the management team's investment committee since its formation. Main Street Capital offers capital solutions for lower middle market companies. And our final witness, Ms. Gwen Mills, Secretary-Treasurer of Unite Here. Ms. Mills has been working with Unite Here for 20 years. She served as the political director from 2015 to 2017 and was elected Secretary-Treasurer in 2017. Unite Here has 300,000 members, largely serving the travel and tourism industry. We will now proceed to President Rosengren's testimony. He will testify, and we will move into 2 rounds of 5-minute questioning. Immediately following the questioning, I'll recognize the second panel of witnesses for their testimony, and then we'll move into that questioning. Each of the witnesses' full written testimony will be made a part of the official hearing record. President Rosengren, welcome, and you're now recognized for 5 minutes.
Representative Hill, Commissioner Ramamurti, Representative Shalala, and Senator Toomey. Thank you for the opportunity to speak about the Main Street Lending Program, which the Boston Fed administers for the Federal Reserve System. My written testimony contains charts and details I hope will be useful to you, but I will be brief in this overview. In addition to tragic loss of life, the pandemic poses an unprecedented shock to our economy. Many entities impacted by the pandemic rely on banks for loans. The Main Street program is designed to facilitate lending to small and medium-sized businesses and nonprofits that have suffered disruptions. It provides credit support for entities that have temporary cash flow problems due to the pandemic and that, given the uncertain outlook, may have difficulty obtaining credit. It can provide a bridge as loans have no interest or principal payments in the first year and no principal payments until year 3. Unlike facilities that purchase standardized credit instruments, this program purchases interest and loans that are by nature bespoke agreements, often with complex borrower-specific terms and conditions. Since our portal opened for registration on the 15th of June, 509 institutions have registered, and their assets represent over $14 trillion, about 58% of banking assets in the United States. Main Street relies on lenders to underwrite loans and keep skin in the game by banks retaining 5% of the loan. Borrowers need to meet the lender's underwriting standards and the program's terms and conditions, and be able to make certifications and commitments, including those required by the CARES Act. The program includes 3 loan facilities for for-profit businesses and 2 for nonprofits that have been announced but are not yet live. Nonprofits and their lenders can nonetheless use the published terms and documents to begin discussing program loans. I'll describe early results. As of Tuesday, over $530 million in loans are active in the portal, 54 loans. 18 loans with a combined value of $109 million have our commitment for purchase or have settled. We opened for purchases on July 6th, and the numbers are consistent with a gradual pace of initial activity, more recently expanding. The 54 loans submitted represent 29 distinct lenders. The largest number of loans are by institutions in the $10 to $50 billion range, but relatively small community banks have participated. To date, there has been limited activity by banks with over $50 billion in assets. But the program's modest initial numbers seem to be giving way to more uptake as participants and banks become more familiar with the program. Quickly scaling up a program to purchase participations in loans from diverse borrowers in a decentralized market that lacks standardization is inherently difficult and a significant achievement. The eventual size of the program will be determined by the path of the pandemic and the economy. Should conditions worsen, which we hope does not happen, I'd expect interest to expand more rapidly. Credit interruptions prolong recessions and harm individuals. In administering the program, we will do all in our power and purview to support the firms, nonprofits, and workers that make up our nation's economy. Thank you for the opportunity to provide this overview. I'd be happy to address any questions.
Thank you, Mr. President, for your testimony, and I'll recognize myself for 5 minutes of questions. First, let me say that I was pleased to see the CFO confidence survey from Duke University recently showing that business believes that they're doing better than maybe they thought they would at this stage of business reopening, and that market access is improving. They're concerned mostly about, obviously, the demand for their products. Also, I was encouraged yesterday that 1.8 million jobs were created and that the unemployment rate fell to 10%. We still have a long way to go, and we're going to be talking about that today as we still have over 10 million people eager to go back to work. And then in my home state of Arkansas, we had a very positive week in the sense that tax revenues, particularly sales tax revenues, were actually over trend and set a record. Our income taxes were 4% over forecast, and our sales tax were 16% over forecast and 15% over 2019. So clearly the economy is reopening, and as Senator Toomey says, we have to keep that in mind as we think through these Federal Reserve facilities and what their best structure should be to accelerate that and get more people back to work in this country. I'm concerned, Mr. Rosentrend, about the affiliation rules. When I looked at the Main Street term sheets, I'm concerned about two things. One, it took 3 months to get the program up and running, and I'd like you to address that first. And secondly, it appears to me in this middle market that these affiliation rules that the Federal Reserve has adopted in the Main Street program really are a significant barrier to more entrepreneurial middle-sized companies that don't have access to PPP and don't have access to the public markets to have access. And I wondered why the Fed, in your view, adopted the SBA 7A type limitations on affiliation rules. Could you handle those two for me, please?
Certainly. First, why don't I address the question that you raised in your opening statement and having this question about why it took so long for this facility to get set up. This facility is very different than some of the other traditional kinds of facilities that central banks operate during a time of crisis. So most of our facilities operate through markets. Market securities, you can purchase them very easily through the market. They clear usually in a couple days, depending on the security. So it's relatively easy to quickly purchase a large number of securities and hold those securities over time. This facility is a facility we didn't have during the financial crisis and really tries to get to a different segment of the population, which is those businesses that are bigger than the PPP program was designed for and smaller than what the corporate facilities are designed for. Bank loans are inherently difficult because they are an agreement between a bank and a borrower. They take a long time for banks to negotiate with the borrower. And this facility has a variety of complex elements, including the requirements of the CARES Act and the 13.3 requirements. So in order to design this program, we first had an initial term sheet. There was very substantial revisions to that term sheet. Again, we came out with another term sheet, which was then again revised. In each of those times where we revised the term sheet, we were expanding the ability of more businesses to access the facility. So the types of changes that were made included lowering the loan size, changing the repayment terms, and lowering the Fed participation amount. The final term sheet for the for-profit businesses started on June 8th. On June 15th, we had the lender registration, and on July 6th, we had loan participation intake. I would highlight as part of this process that it's a highly automated process. We have to do programming, so we needed the legal documents to be in order. We needed the final term sheet to be completed, and we needed to be able to do the programming and then check and make sure that the programming worked as expected and met all the security needs of this program. So that does take some time. It did take time to start up. And I think that gives you some idea of the complexity of the program and why it took so long.
Yes.
In terms of the...
Thank you for that. I think the key thing is if we want to change the program, you don't anticipate it taking another 3 months to produce a different kind of Main Street term sheet if that were necessary.
It would depend on what the nature of the term sheet changes were. If the term sheet doesn't affect the underlying legal documents, it's much easier to implement. So there are changes that have been made as we've had changes in the term sheet. That's true for the nonprofit term sheet as well. Depending on the nature of what the changes were would determine how long it took us to actually get set up.
Thank you, Mr. Chairman. President Rosengren, you admit that the Main Street program is off to a slow start, but your testimony is that interest in the program will likely pick up if, quote, the pandemic and the economy worsen. But if you look at the data, Main Street companies are already getting crushed. The latest middle market indicator and economic outlook survey of executives of mid-sized companies shows that in the second quarter, these companies experienced the largest decline in employment in the survey's history. They also had the biggest drop-off in revenue in the survey's history. Other surveys, like the U.S. Chamber of Commerce's Middle Market Business Index, show the same thing: massive layoffs and furloughs and widespread revenue declines. So my question is, how much worse do things have to get before companies are interested in the Main Street lending program?
Well, I think we actually have seen significant pickup recently in the portal. Just as an example, there were $109 million loans in committed or settled as of last Tuesday. And 2 days later, we now have 29 loans and $189 million. So there is a pickup in volume. It's particularly in the community and mid-sized banks. Similarly, we had $530 million in loans in the portal 2 days ago. As of last night, at $635 million. And so I think this is early stages of this program. And the reason is because banks and borrowers have to negotiate the terms. They had to know what the term sheet was. They had to understand the characteristics of the program and how the portal worked. And so it takes some time for the banks and the borrowers to get familiar with the program and to start pledging those loans to the facility. So in the first couple of weeks, the banks had not completed that process and the borrowers had not completed the process, and there was not much volume. And we're slowly seeing an increase in volume over time that I would expect to continue. So one of the challenges with trying to deal with bank loans as opposed to securities is it doesn't happen quickly. If you talk to large firms about a renegotiation of a line of credit, it can frequently take many, many months before they get the negotiation completed. So one of the advantages of a bank loan is that you are able to tailor it to the needs of the borrower and the bank. There are conditions that a different bank may put on that same kind of loan, and there are a lot of differences across both banks and borrowers in what these loan agreements look like.
Thank you,
this is
President Rosengren. Just
standard agreement.
in the interest of time, I'll move on. And I'll just note that even $530 million, which you said is in the pipeline right now, that's still a tiny fraction of the total lending capacity that was created for this program. Look, as I said in my opening remarks, I think this program has been a failure, and the basic reason for that is that the Fed can only offer loans. The data show that companies, even distressed companies, aren't looking for loans. Just this week, the Fed released a survey of senior loan officers finding that in the second quarter of 2020, demand for loans from companies of all sizes went down. Similarly, the most recent National Federation of Independent Business survey of small businesses found that only 3% of business owners reported that all their borrowing needs were not satisfied. And in the testimony they submitted today, the Bank Policy Institute, which represents some of the biggest banks in the country, said they've seen, quote, a lack of demand for Main Street program loans from their clients. So, President Rosengren, if the Main Street program can only offer loans, and it's clear that most small and mid-sized firms aren't looking for loans right now, even though they're already struggling badly, then how is this program going to stop widespread business closures and job losses?
So this program is tailored to organizations that will be helped by loans. So if you're a business that have had no problem from the pandemic and have a pristine balance sheet, you're probably going to get better financing than the Main Street program provides. If you're a business that's deeply troubled and is in danger of closing imminently, this program is not going to solve the problem because debt doesn't solve that kind of problem, equity does. This program is designed for a business that had a disruption in short-term credit, that was in good shape prior to the crisis, and who, after the pandemic subsides, would be able to be a viable business as well. There are businesses that fit that characteristics. We're seeing some of those businesses actually coming to the facility. I am expecting over time that we will see more pickup. Again, we are seeing some significant activity by some of the community banks and mid-sized banks, particularly those located in states like Florida, Texas, and places that have been badly impacted by the pandemic recently.
Okay, thank you, President Rosengren. Look, I recognize that you and the Fed staff have done a lot of work on this, but I think the issue is that the Fed is trying to solve a problem that doesn't exist, and it's incapable of solving the problem that does exist. By law, the Fed can only support loans, and more loans are not the answer here for most companies. And this is a giant hole in our economic response to the crisis. Congress helped small businesses through the PPP. Congress helped large companies that are big enough to issue bonds by empowering the Fed to purchase corporate bonds and reduce the cost of borrowing. But the only thing that the government has offered all these companies in between is the Main Street program, and it's just not working. And these mid-sized companies employ 45 million people and represent a third of private sector GDP. So look, I don't think continuing to tweak this program is going to work. I think Congress needs to act to provide direct support to mid-sized firms, and for that money to come with real strings attached so the money benefits working people. Thank you, Mr. Chairman.
The gentleman yields back. Thank you. Congresswoman Shalala is recognized for 5 minutes.
Thank you. Let me follow up a little on that. Particular sectors like the hospitality industry have been very hard hit by the virus, in my district in particular. And as has been noted, only 109 million of the 600 billion has been injected into the economy. I want to know whether there is actually a design flaw, not the issue of that Bharat raised about whether we should have this program at all, but whether it's designed in a way, which is another way of getting at that. In particular, some have suggested that the terms of the program, such as the leverage ratio requirements and the loans priority and security requirements, are better designed to protect the government from losses than to provide liquidity to a broad range of small and mid-sized businesses. Could you respond to that?
Yes. So this program's designed as a cash flow program. So it's designed for a business that expects to be able to pay off the debt and pay off the debt with the cash flow from its normal business operations. So that fits for many businesses. It doesn't fit for all businesses. For the smallest type of businesses, I agree that the PPP program is a much better program for them. It's more of a grant program than it is a debt program, and debt may not help them in that situation. In terms of the underwriting standards, the debt to EBITDA standard follows industry practice. So depending on which of the facility parts, you either have a debt to EBITDA of 4 or a debt to EBITDA of 6. Many banks expect to have a debt to EBITDA below that. And so I think that this program actually closely mirrors the kind of leverage that many banks themselves are expecting when they're looking for a loan to be bankable. So it's a combination of an underwriting standard. There are not many underwriting standards in this program. It is basically a debt to EBITDA and the fact that the bank is willing to underwrite the loan themselves and take a 5% stake.
The Federal Reserve recently reported that banks were actually tightening their credit standards due to the uncertain economic outlook that's resulted from the pandemic. The Fed allows banks to use these tighter credit standards in determining whether or not to make a loan under the Main Street lending program. If the goal is to get money out to needy borrowers, doesn't the policy of letting the banks use their tighter credit standards undermine that goal?
So the challenge is that this is a lending program, and so loans have to be paid back. And we're asking banks to voluntarily participate in the program, and we're asking banks to be sure that when they underwrite the loan, it's a loan that it is to a business that has had their credit disrupted, but that over time you expect it to be a thriving business. So that doesn't qualify all businesses. It qualifies a particular kind of business that's appropriate for this program. So business has been disrupted and is likely to be solvent. That isn't attractive for this program. And from the perspective of the bank, they might not be willing to do that loan otherwise. Let me just give a simple example, a movie theater. So if you're a movie theater located in Miami and you've been closed in the spring, you opened up temporarily and now you may have to be closed again because of the restrictions either imposed at the state level or because people don't want to be in a movie theater at a time of a pandemic. The bank may be quite uncertain about when that loan would actually be paying because they don't know how long the pandemic will occur. They don't know when there will be a vaccine or a treatment and might not be willing to take that loan at this kind of rate given that uncertainty. So because they're providing 95% of the loan to the Federal Reserve, they might be willing to provide support to that movie theater because the bulk of the risk is being taken by the Federal Reserve. So this is a lending program. It is focused on, in part, getting most of these loans paid. That's a requirement of the 13 facilities.
Ms. Anderson, who's here on behalf of the Bank Policy Institute, suggested in her written testimony that if the Fed wants banks to lend to borrowers who do not meet the bank's current underwriting standards, which have tightened, in response to the economic uncertainty caused by the pandemic, the Fed must modify the design of the program to provide downside credit risk protection. In making this observation, she cites the negative treatment of these loans by regulators as disincentivizing banks to loosen their underwriting standards. Has the Fed considered this issue?
Yeah, we've spent quite a bit of time thinking about the supervisory issues related to these loans. So the pandemic, like other natural disasters, if there was a hurricane that hit Miami, we then use guidance to make clear that we want to have a little more leeway given to those loans because of the nature of the crisis that occurred. The same thing has been done for this pandemic. So we've asked our bank examiners to work with bank management in the instances in which they're making a decision, such as a Main Street loan, where the borrower has been disrupted. The other regulators have agreed to this and are following the same general guidelines. So I think that in the end, the loan has to have the same classification standards that a standard loan does. But the regulators now are looking at loans a little bit differently and asking the banks to work with their borrowers. And that's what for the pandemic, that's what we do during other natural crises.
Thank you, Doctor. Gentlewoman's time has expired. Senator Toomey.
Thanks, Mr. Chairman. Dr. Rosengren, thank you for testifying today. Let me just start by pointing out, government money can never be a replacement for an economy. And we've spent many hundreds of billions of dollars covering 8 weeks of payroll for very small companies. This program was never designed to pick up the tab for the payroll of the American workforce. Well, what it was designed to do, as I recall, was to provide emergency liquidity in the hopes that it would keep viable companies alive so that workers would have a place to go back to. Part of the reason that we made unemployment benefits so much more generous than they've ever been in the history of the country is because we knew that it was inevitable that in a very, very severe, hopefully brief recession, there would unavoidably be people laid off who had no work to do because in some cases their companies were closed, forbidden from working. What I'd like to understand, and this has come up, and maybe this is just another way to think about this, but to what extent do you think that the loans that have been made so far through this program are loans that would not have been made in the absence of the program? In other words, is this designed in such a way that the only loans that are going to take place are loans that would have happened anyway, especially given the underwriting requirements on the banks and their required participation?
I mean, these loans have a different characteristic than the traditional bank loan. So it's not traditional that you have no payment of principal or interest the first year and no payment of principal the second year. That really is designed for a disrupted cash flow, but the ability of the borrower over time to actually be able to make payments. When we've talked to some of the banks that have been making the loans, they have told us that these are loans that more than likely they would not have made in the absence of this program. The reason is because there's a great deal of uncertainty right now. Congresswoman Shalala highlighted the uncertainty and the survey of terms of lending that she cited. The uncertainty is very, very high right now. And that is a situation where banks become more reluctant to lend because they don't know what the condition of the borrowers will be. So I do think that this plays an important role in reducing the risk. And if the pandemic gets worse in the fall, as at least some epidemiologists are saying, this program will probably be more extensively used. I completely agree with your observation that a 13.3 facility does not solve a pandemic problem. It's primarily a public health problem, but we can certainly mitigate the cost of that public health problem by trying to help those businesses that have been disrupted, but were very good businesses prior to the pandemic and will be very good businesses after the pandemic.
And just a technical question about the fee structure, because it's a little confusing the way it appears on the term sheets. When a bank makes a loan and 95% of it is taken by the Fed, the fee structure that the bank keeps, certainly they have the net interest income that they can earn on the 5% that they keep. The fee structure, which if it's 100 basis points, which I think is contemplated in the term sheet, does the bank keep 100 basis points on the 5% that it keeps, and the balance goes to the, how does that fee structure work out?
It's on the total loan. This is an incentive for the banks to participate in the program.
So the banks start off with 20% of their credit exposure in fee income. Is that correct?
That is correct, but there are costs to doing the underwriting of the loan.
Of course they are, but if you do a large transaction, that's extremely unusual, right? So that would appear on the surface to be an inducement, an encouragement, incentive to take more risk, but the banks are institutionally not oriented towards lowering their standards because there is an outsized source of revenue. Would there be other kinds of lending institutions, for instance, BDCs, that might be more inclined by their nature to be able and willing to take more credit risk because they recognize that coming out of the blocks with 20% of your credit risk and fees covers a lot of risk?
There are other types of organizations that provide loans in the market other than banks. This program is designed for depository organizations. In part, we want to be able to get this facility up and running quickly. In part, we have to make sure that BSA, AML, and know your customer kinds of conditions are also met. So that is why this program has primarily been operated through the banking system.
Well, I see I'm out of time, but I do want to follow up on the possibility that this kind of risk return structure might be even better suited for other financial institutions. That is not to say that banks shouldn't participate, but maybe we should broaden the universe of institutions that are permitted to participate.
Thank you, Senator
Thanks, Mr.
Toomey.
Chairman.
We're going to do a second round now with Dr. Rosengren, and I'll start that with 5 minutes. And as I start my second round, I want to ask unanimous consent to put two letters in the record, one from Senator Crapo dated July 31st with comments about the Main Street lending facility, and also a letter dated August 4th from Senators Loeffler, Cornyn, Braun, and Tillis on the Main Street. Not hearing any objection, those will be included in the record. Dr. Rosengren, you talked about you limited to depository institutions to get up and running quickly, and yet there are only 150 banks or so listed on the Fed's website thus far as registered lenders. And I cite that because in the emergency environment, right at the end of March and April, we were able to stand up the PPP program over in the CARES Act, and 5,400 banks swung into action in a patriotic way, and in 7 days began distributing $520 billion and making 5 million PPP loans. Granted, certainly the underwriting was very different. The mission was very different. I got that. But I'm concerned about the reluctance of banks to participate in the program. Arkansas has 86 banks, and yet only 2 banks headquartered in my state that are local banks have agreed to participate. So I really hope as we have this hearing today, we'll talk more about that. Let me turn and talk about the term sheet. As you've noted, it's really a cash flow lending exercise based on a pre-tax, pre-depreciation, amortization multiple and implied leverage. In other words, it looks like a very traditional bank loan. Where is the higher risk component that was contemplated in the CARES Act section that encouraged help for particularly distressed sectors of the economy? Could you comment on that, Dr. Rosengren?
So I think these loans already are going to be risky. Doing lending in the middle of a pandemic, particularly if it's a sector of the economy where social distancing is difficult. So tourism, hotels, retail have all been badly affected by the pandemic. And some of those, as we've seen, there have been very large bankruptcies of retailers, for example. So these loans are not without risk. And I fully expect that some of the loans that we're going to do over time will have a loss. So that's why we have a Treasury backstop. So I think this program has taken on a fair bit of risk. I think that over time, as the portfolio grows, we are going to have some significant losses. Hopefully that doesn't occur. Hopefully everybody is able to pay back the loan completely. But if the economy doesn't do well, particularly if the pandemic worsens, it's quite possible that we will experience significant losses.
Thank
So
you.
I think that this program did focus on trying to get loans to fairly risky borrowers.
I thank you for that, but when you do look at the terms, I mean, you really are, I agree, companies at the margin are certainly middle market companies that couldn't access the public markets or were not eligible for PPP. Many would qualify here, but as I noted earlier, I think the affiliation rules make that more difficult. And I think the very traditional lending profile that's contained in this term sheet also could be a detriment to companies. Let me give you an example, and this was talked about with Secretary Mnuchin and Chairman Powell at our meeting of a few weeks ago, and that is someone who doesn't have good EBITDA in 2019. They certainly don't have it in 2020, but at the end of the year in 2019, they had very good collateral valuation. They had a low loan to cost potentially. They had a low loan to value potentially. They have room to lend, but they cannot meet the EBITDA standards. And both Jay Powell and Steve Mnuchin said they were, quote, interested in looking at a collateral dependent or asset-based loan. Can you tell us what the status of that look is?
So this is the Main Street program is a cash flow program. If asset-based financing.
But there are a lot of Main Street firms, Mr. President, that don't have cash flow in 2019, but they are absolutely a small middle market type company. And so I know the Main Street term sheet's currently a cash flow. I'm asking, is there current discussion underway to expand a different Main Street facility that would be more of an asset-based loan rather than a cash flow loan?
I know there are discussions about asset-based financing and some of the difficulties experienced, for example, in commercial real estate. So there have been ongoing discussions about this, but there is no term sheet that is imminent.
Thank you for that. Also, startup companies, truly people in the startup space have a disproportionate amount of costs. Are you looking at startups and what they might need in the Main Street arena?
Many times, startups need equity more than they need debt. So I think frequently a true startup is going to find other types of financing vehicles more attractive. This is more of a program for established businesses that have experienced a disruption of cash flow.
Thank you, Mr. President. Let me yield to my friend, Mr. Ramamurthy, for 5 minutes.
Thank you, Mr. Chairman. In early April, the Fed announced the first version of the Main Street lending program. That announcement described certain basic features of the program, like the maximum loan amount and the rates and terms for loans. A few weeks later, the Fed announced major changes to the program. Many of those changes lined up exactly with what members of the oil and gas industry had requested. That did not appear to be a coincidence. Shortly before the changes were announced, President Trump publicly promised that oil and gas companies would be taken care of. And then shortly after the changes were announced, the Energy Secretary went on TV and bragged about how he and Treasury Secretary Mnuchin had succeeded in getting the Fed to make changes that the oil and gas industry wanted. But when asked by reporters, a spokesperson for the Fed denied that the Fed had made any adjustments out of consideration for the oil and gas industry. Instead, the Fed said that the April changes reflected the more than 2,000 public comments that the Fed had received about the initial design of the program. So President Rosengren, as the regional Fed president responsible for the Main Street program, do you stand by the Fed's earlier statement that certain adjustments were not made specifically to help oil and gas companies?
I do. This is a broad-based program. It's been a broad-based program from the start. 13.3 facilities require broad-based kinds of terms, and so it's not targeted at specific firms or specific industries. 13.3 facilities are not available for that kind of lending.
Thank you. And look, I want to focus specifically on the changes that were made to the facility in April. Let's look at one of them. According to Reuters, in mid-April, one of the key changes the Energy Secretary and Treasury Secretary were pushing for to help the oil and gas industry was increasing the maximum loan amount to at least $200 million. A couple weeks later, when the Fed announced its changes to the Main Street program, the maximum loan amount had gone up to exactly $200 million. President Rosengren, out of the more than 2,000 public comments that were submitted to the Fed on the Main Street program, are you aware of a single one that requested increasing the maximum loan amount to $200 million?
We got many comments from both banks and businesses that if the loan amount was larger, that it would be more attractive facility for them. Remember, a lot of this discussion was occurring in March and April. The economic conditions and the pandemic conditions were very different at that time. And there was a lot of concern that some fairly large businesses would have difficulty getting financing. Fortunately, the pandemic subsided, at least for a couple months. And as a result, many of those large borrowers that thought that they were going to need the financing, at least to date, have not actually accessed the program. I would highlight.
Just in the interest of time, I want to move on because, look, I reviewed each and every one of those 2,000 plus comments, and there wasn't a single one that requested specifically a $200 million maximum loan amount. The only people making that request were the Energy Secretary and the Treasury Secretary after meetings with the oil and gas industry. Here's another change. The first version of the Main Street program required companies to say in writing that they needed the loan, quote, due to the exigent circumstances presented by the COVID-19 pandemic. Advocates for the oil and gas industry pushed to eliminate that requirement, presumably because many oil and gas firms were struggling before COVID and couldn't satisfy the requirement. And again, in the final version, the Fed eliminated that requirement. President Rosengren, again, out of the more than 2,000 public comments that the Fed received, are you aware of a single one outside the oil and gas industry that requested that the Fed remove this important requirement?
In the discussions I've been involved in, we do not discuss specific industries. We discuss how we can provide a broad-based financing scheme.
Okay, I appreciate that, but again, I reviewed the public comments, and there wasn't a single one that requested this change. Only the oil and gas lobby had requested it. So I just want to ask one more time. Despite evidence that President Trump wanted oil and gas companies to get federal relief, that the Energy Secretary and the Treasury Secretary pushed the Fed for specific changes to accommodate the oil and gas industry, and that the Fed made changes that the oil and gas industry requested, but no other industry or group requested, is it still your position that the Fed did not make certain changes to accommodate the oil and gas industry?
It is my position that the focus has been a broad-based lending program, not focused on any particular industry.
Okay, look, I think that, again, my focus is on specifically the changes that were made, not the overall scope of the program. And I think the evidence here is strong and deeply concerning. This is just not how the Fed is supposed to operate. The Fed is not supposed to be changing the rules of these programs so that the president's favorite companies can get access to billions of dollars in public money. In fact, it is illegal for the Fed to structure these lending programs to help specific companies avoid bankruptcy. I urge this commission to further investigate this issue, including by requesting all communications on this topic between the Fed and the Energy Secretary, the Treasury Secretary, and any representatives of the oil and gas industry. Thank you, Mr. Chairman.
Thank you. Gentleman yields back. Congresswoman Shalala is recognized for 5 minutes.
Thank you. My colleague is appropriately asking why the loan is as big as it is. I'm actually interested in why it isn't smaller. Commentators have speculated the minimum loan amount of $250,000 is too large and precludes participation by many small and mid-sized businesses. I'm aware that the Fed has already reduced the minimum loan amount down from $1 million to $250,000, which may still be too high. For instance, the American Bankers Association and the Marketplace Lending Association have separately suggested that $50,000 may be a more appropriate amount. Has the Fed conducted studies on whether the $250,000 loan minimum excludes parts of the market that this program is supposed to help? What changes can be made to make the program more broadly acceptable and accessible?
So for many of those smaller businesses, the PPP program was designed to target that segment of the industry. The PPP program is much more attractive to a small business because it has the ability to be a grant. So this program was really designed for businesses that didn't qualify for the PPP program and nonetheless might have a need for credit. So if you look at the actual loans that are in our portal, the sum of the loans that are actually in the portal is $1 to $5 million. That is the type of loan that we're seeing is dental companies, construction companies, design companies, retailers. These are businesses that frequently are going to have a $1 to $5 million loan. And it's not surprising that that's what we're actually seeing. Now, we have seen some loans that are much bigger. We've seen some loans that are much smaller. But I would say that so far has been where we've seen the bulk of the activity.
So you're not considering going below 250,000?
I think there are probably other programs that are better designed. So a real question is whether a cash flow lending program such as Main Street is appropriate for very small businesses, and whether there might be better targeted tools that can address that. In particular, will more debt help that small business, or might it push it towards bankruptcy and closure? So we want to make sure that we provide debt to businesses that can use it and actually pay it back. We don't give businesses so much debt that they're not able to survive.
Thank you. Let me talk about the nonprofit organizations. A few weeks ago, you expanded the Main Street lending program to nonprofit organizations. Although these facilities are not yet live, I'm concerned that the program requirements are too rigorous and will preclude participation by many of the nonprofits that need credit to survive the pandemic. For example, the minimum loan size is $250,000, which may be too large for many smaller organizations. Borrowers are also required to have at least 60% of their expenses covered by non-donation revenue, which can be very hard for many non-profits to achieve. Can you talk about why the program was designed this way? I'm very familiar with nonprofits, and that 60% requirement seems to me will block many nonprofits. I'd appreciate hearing about any analysis that the Fed has done regarding the nonprofit interest and eligibility in the program. Have you considered changing any of the eligibility requirements? And lastly, when do you expect the program to be launched?
So in terms of the nonprofit term sheet, when the first term sheet came out, we got extensive comments from a wide variety of nonprofits and a wide variety of banks. Many banks actually don't lend to nonprofits because it's a very different nature. Many of the large nonprofits, University of Wisconsin, which you used to be associated with, probably goes to debt markets rather than relying primarily on bank markets. That's true for many hospitals as well. So this is a market that has not been extensively tapped by many banks, and I think it's a new market for many banks. I think there is an opportunity for more nonprofits to be able to access bank financing through this program. We did make significant adjustments in the term sheet. When we were thinking about the term sheet and the adjustments we made between the first and the second term sheet, we spent an extensive amount of outreach understanding how banks underwrote these loans and how rating agencies underwrote these loans. These criteria broadly match what many of the banks told us the criteria was that they used. And between the first and second term sheet, we did relax it in response to the comment that it was being too restrictive. In terms of when this facility is going to be up, we just got the legal documents up. The term sheet is now finished. We are in the process of doing the programming now. It's going to probably take us another several weeks before it's up and running. But I would highlight that now that the legal bank loans don't get made quickly. So now that the legal documents are up and running, now that the term sheet is widely available, banks can start the negotiation with nonprofits so that when the facility is available, they are able to quickly submit it to the facility and get it funded. So because of the long lags in making these kind of agreements, I would think that this will be about the time that if a bank was going to do a nonprofit loan, that will probably be up and running around the time that they complete the legal agreement with the borrower.
Thank you, Dr. Rosenrud. The gentlewoman's time has expired. Senator Toomey.
Thanks, Mr. Chairman. Dr. Rosengren, I'd like to just have final clarity on this. Just answer this if you would. Is there any Main Street lending program that is available only to the oil and gas sector?
No.
And is there any program, the terms of which are suitable only to the oil and gas sector?
No.
Thank you. I want to underscore a point that Congressman Hill raised, which is some real challenges with the affiliation rule. firms that when we were drafting this legislation, we did not think would be automatically excluded from financing. I also want to underscore his point about considering asset-based facilities. I think you're very well aware there are some real challenges in the commercial mortgage-backed security market right now. In particular, the hotel subset of the commercial mortgage-backed sector is experiencing some real difficulties, and because they generally don't qualify for the EBITDA criteria, there's no access to this. As you know, the problem is exacerbated by the obligation of the servicers to go on and make payments, irrespective of the ability of the borrower to do so. So I would like to encourage you, as I have encouraged Secretary Mnuchin and Chairman Powell, to consider whether there shouldn't be an asset-based category. If there is an appropriate loan to value, that maybe that's a criteria that that we ought to consider. Do you have any thoughts on whether we ought to stand up a facility specifically designed? It would be designed generally for the broad category of real estate, I think, and other categories that would be more suitable for an asset-based lending than they are for an EBITDA constraint.
Yeah, so an asset program would differ from what we have for Main Street. So it would be a different facility if it was done through a facility. Most of that type of lending has a much longer maturity than 5 years. So as you know, these are 5-year loans with a balloon payment at the end of the 5 years. That's probably not appropriate, for example, for retail or for commercial real estate such as hotels. So the nature of that program would be quite different. I know there is work being done thinking about how asset-based can be addressed, including through the SBA. So I think there are a number of proposals that are being considered. I'm certainly aware that there are many concerns in the commercial real estate industry, and those concerns will get even worse if the pandemic gets worse.
Right. So I want to go back to that. On page 11 of your testimony, you indicated that you believe that should the pandemic and the economic circumstances worsen, we might very well see greater interest in the Main Street lending programs. And I can certainly understand that leading to greater demand on the corporate borrower side. But could you address why you believe that wouldn't be offset by greater reluctance on the part of banks to take on the exposure in that scenario in which the environment worsens?
So there are many borrowers who could take 2 or 3 months of disrupted cash flow. And if it was only 2 or 3 months, those may be bankable loans right now, and they might be able to get a rate that's better than LIBOR plus 300 basis points. However, if we go through another 3 months, so that in 1 year's time, they've experienced 6 months of badly disrupted cash flow, some of those loans that might have been attractive to get direct financing from the bank through their standard bank borrower relationship may no longer be possible, and the bank may only be willing to do it if the Federal Reserve takes the 95% stake that is part of this Main Street program. So I agree with you that risk aversion by banks may increase if the pandemic gets worse, and there already is very substantial uncertainty. But many borrowers that can't get access from their banks are going to be looking to the Main Street program to provide that type of financing.
Thank you very much. Thank you, Mr. Chairman.
Gentleman yields back. Thank you, Mr. Toomey. And now we'll hear from Ms. Anderson on our second. But first, let me thank Dr. Rosengren for his testimony today. We very much appreciate your written testimony and the interaction with our commissioners. And now let us turn to our second panel. We're going to hear from Ms. Anderson with the Bank Policy Institute first. Ms. Anderson, you're recognized for 5 minutes.
Thank you. Members of the Commission, my name is Lauren Anderson, and I'm Senior Vice President and Associate General Counsel at the Bank Policy Institute. I thank you for the opportunity to be a witness at today's hearing regarding the Main Street Lending Program. BPI is a nonpartisan public policy research and advocacy group representing the nation's leading banks. Our members employ nearly 2 million Americans, make 72% of all loans, and nearly half of the nation's small business loans. BPI strongly supports the efforts to date, as well as ongoing efforts by Congress, the Treasury, and the Federal Reserve to tackle the COVID crisis and provide much-needed relief to households and businesses. At the outset, it is worth noting how unique the Main Street program is in relation to emergency lending programs established during the pandemic, or even in 2008 and 2009. It is not a loan forgiveness or grant program like the PPP, and it is not a market liquidity program for debt of investment-grade borrowers. Main Street requires credit underwriting decisions on a heterogeneous set of individual non-bank borrowers, which is challenging and not something the Federal Reserve has done before. With the expansion of Main Street to nonprofit organizations, which themselves are very different across different sectors, the Federal Reserve ventured even further into uncharted territory. BPI, working with commercial lending experts from our member banks, has been actively engaged in commenting on the program since the initial term sheets were published in early April and through subsequent iterations. The focus of our comments has largely been on ensuring the terms of the program are consistent with market practices and ensuring prudent risk management to safeguard taxpayer funds. We commend the Federal Reserve for seeking public comment on the terms of the program and engaging in an iterative process to try and improve the end result. We are very pleased that the program began accepting lender registration in June and officially became operational on July 6. Since then, lenders continue to register and loans, albeit a small amount, are being made. Many BPI member banks have registered and are in the process of reviewing borrower inquiries. While the limited number of loans made thus far has been a concern to some, it must be assessed in the context of a larger commercial credit ecosystem. First, for many small businesses, Main Street may not be the right fit given the complexity of the program and the compliance requirements. However, BPI member banks help to provide over 1.6 million PPP loans, totaling over $188 billion, to help small businesses meet payroll needs. Second, larger corporates retain access to capital markets, which remain extremely active with the support of numerous Federal Reserve programs. Investment-grade debt and corporate debt has been issued at record levels, with U.S. companies raising over $1 trillion year to date. Third, and perhaps most significantly, over the course of March and April, both small and large businesses drew down on existing credit lines. Between February 12th and April 1st, bank loans increased by approximately $700 billion. Thus, a lack of demand for Main Street loans likely indicates that many other eligible businesses are finding credit through other market channels. A second reason why there is limited demand for Main Street is the fact that the program not only requires borrowers to meet certain eligibility criteria, but also to satisfy bank underwriting standards. And if a borrower can meet bank underwriting standards, it is not surprising that they are finding credit solutions through traditional market channels. Where the Main Street program may become more useful is if banks become balance sheet constrained and cannot lend the full amount needed by a creditworthy borrower. If this were to occur, Main Street may provide the solution, but so far bank balance sheets are robust and weathering the crisis. If, however, Congress, the Treasury, or the Federal Reserve desires to provide further relief to small and mid-sized businesses experiencing acute stress due to the pandemic, including less creditworthy borrowers who would not currently pass bank underwriting standards, the design of the program would need to be modified. At the moment, the program is not designed to provide loans to less than creditworthy borrowers. If banks are to provide loans to borrowers who cannot meet current bank underwriting standards, the government would need to provide downside credit risk protection that would allow Main Street loans to be considered lower risk. I thank you again for the opportunity to be a witness for the Commission, and I look forward to answering your questions. Thank you very much.
Thank you, Ms. Anderson. Appreciate your testimony. We'll now turn to Mr. Bond. You're recognized for 5 minutes.
Well, thank you. Good morning, and thank you for the invitation to speak today. Congressman Hill, Commissioner Ramamurti, Congresswoman Shalala, and Senator Toomey, I appreciate the gravity and the responsibility before you. Admire your willingness and respect your commitment to ensure that federal relief programs enacted through Coronavirus Aid, Relief, and Economic Security Act are both accessible and effective. I am here this morning to provide testimony from the perspective of middle market borrowers to help answer the question that you all are asking of who the Main Street lending program is helping. Regrettably, I have no answer to offer you. We could neither borrow from the program nor find someone in our membership who has received a loan through it. To help illustrate the current obstacles to securing loans through MSLP, I'd like to share some comments from our members who completed a survey administered in recent days. I won't read all of them. These are their words, not mine. The program is moving too slowly, whereas COVID-19 dramatically and quickly caused an impact. We actively solicited an MSLP loan for a minority business enterprise at companies whose performance is only 10 to 15% lower during the pandemic as it was beforehand. We approached 15 lenders, not one was interested. If the MSLP applies to the lower middle market, it is news to me. If it does, please send guidelines. We were excited about the program initially and had 2 companies that would be perfect for the program, but the banks won't do it. We have plenty more comments that address the challenges faced by both borrowers and lenders, which I'm happy to provide the Commission for its review and reporting purposes. As the CEO and president of the Association for Corporate Growth, ACG, I come before you today as an employer and the leader of an association that represents a vitally important segment of the economy, which employed some 45 million Americans prior to the pandemic. Founded in 1954, ACG's 15,000 members operated, buys, and grow approximately 200,000 middle market companies. As a networking organization, which hosted more than 1,100 live events annually, ACG, like many other associations, were devastated by COVID. I lead a staff of nearly 30 people based out of Chicago, or now all over the country, as well as oversee operations in 60 chapters, primarily in North America. When the Paycheck Protection Program was announced, a grant through it would have served as an $800,000 lifeline for my Chicago team and staff members dispersed throughout the country. However, as a 501c6, we too were ineligible. Consequently, we made more than $600,000 in salary cuts, currently forecasted to continue through December and beyond. Since March, every conversation with our members finds them in the same position. With their employees at the forefront of their operations, they managed cash flow, tried to prevent layoffs, and worked diligently to retain employees and not lose institutional knowledge. When PPP was closed to us, like many other associations and a large percentage of our member companies, we looked in earnest at the Main Street Lending Program. A loan would allow us to invest in the digital enhancements to our infrastructure that would ensure we could continue to deliver strong member value and the necessary tools for business development in this new virtual world. But there too, we found another closed door, as did our members. Perhaps naively, we thought the Main Street Lending Program would be accessible to organizations and companies excluded from the PPP. Suffice to say, it hasn't been accessed by many. In your recent report, you talked about the Goldman Sachs estimating some 45 million Americans, or 40% of the private sector, are employed by companies who are eligible for MSLP, yet very few had purchased a loan. Further, Chairman Powell recognized the challenges with the small and medium-sized businesses for which MSLP is intended. It is new territory for the Federal Reserve and very complex because businesses are, and I quote, broad and heterogeneous class of borrowers with diverse needs. In our opinion, the challenges with the Main Street Lending Program are twofold and equate to awareness and access. Our recent survey found 22% of the respondents completely unaware of MSLP. And of the respondents who want to apply for the loans through the program, 81% were unable. When asked what changes they could help, they suggested the removal or the overhaul of the following items, which some of you have talked about today. Removal of the adherence to the SBA affiliate definition. We talked about the EBITDA leverage size base test, which excludes many companies, particularly those early in their life cycle and family-owned businesses. Distribution dividends restrictions for 1 year after a loan payoff. Employee compensation restrictions for 1 year after loan payoff. Decreasing the minimum loan size. Look, creating a greater awareness of the MSLP and increasing accessibility should result in a groundswell of applicants. We believe that. The effect should help companies retain jobs and maintain operations, and consequently preserve healthcare insurance for millions of Americans in this increasingly unpredictable economy tethered to COVID-19. We stand to support you in any way you need and hope to answer any questions you may have today. Thank you.
Thank you, Mr. Bond. And now we'll hear from Mr. Foster. You're recognized for 5 minutes.
Is that right? Okay, can you hear me?
We can.
Great, sorry about that. Okay, members of the commission, thank you for inviting me today to testify on the state of the Federal Reserve's Main Street Lending Program. I'm Vince Foster, Executive Chairman of Main Street Capital. Main Street Capital is an active member of the Small Business Investor Alliance in Washington. We provide long-term debt and equity financing to lower middle market U.S. businesses. We currently have investments in 68 lower middle market businesses in 26 states, in which our average ownership is 36%. These businesses, on average, each have roughly 200 employees. The Main Street Lending Program, while enacted to assist businesses like our portfolio companies weather the economic storm brought on by the pandemic, is not responsive to their needs as currently structured. The principal structural problems are, number one, requiring lenders to undertake full credit underwriting for small to mid-sized borrowers seeking 3.5%, 4 to 6 times EBITDA loans results in a risk-reward mismatch. Lenders are better off expending their time and capital underwriting conventional loans. Number two, requiring 15% amortization in year 3 of the loans is a non-market and very onerous provision, effectively requiring the loans to be refinanced after 2 years. Number three, prohibiting contractual subordination in the case of the new loan facility and requiring in the case of the priority loan facility, senior or pari passu priority to existing debt is problematic in that most companies will have pre-existing senior debt outstanding, the terms of which will have to be renegotiated. Number four, testing the maximum number of employees and revenue utilizing the affiliation rules contained in the Small Business Administration regulations applicable to 7A loans without the exceptions included in the PPP program dramatically reduces the number of companies eligible for the Main Street Lending Program. The lending facilities as currently structured are unattractive to those borrowers that are reasonably creditworthy, as less restrictive financing is likely to be available from conventional sources. Yet the facilities remain unavailable due to lender reluctance to accept balance sheet exposure with respect to less creditworthy borrowers. The following structural changes would make the program more attractive to both lenders and borrowers to advance Congress's objectives. Number one, the loan should be unsecured and subject to pre-existing contractual subordination and rank junior in priority to other pre-existing senior debt. Number two, the loan should have a term of 7 years, generally sufficient to allow them to mature after the maturity dates of pre-existing debt. Amortization should not begin until the end of year 4. Number three, the multiples of 2019 adjusted EBITDA should be increased from 4 times in the new loan facility and 6 times in the priority facility to 6 times and 7.5 times respectively. There should also be elective asset-based criteria, such as a percentage of loan to value and or a 1.2 times minimum debt service coverage ratio, instead of using solely leverage multiples for all industries. Number four, experienced non-bank lenders should be permitted to participate as eligible lenders, similar to the PPP program. The loan should have an interest rate of LIBOR plus 400 rather than 300 basis points, and the upfront origination fee payable to the lender should be increased to 200 basis points paid by Treasury. Number five, the affiliation rule should not limit an affiliated group to a single Main Street facility or a single lending facility size limitation where more than one group member would like to access that or another Main Street lending facility. And finally, number six, one of our lenders, a highly respected and conservative regional bank, has elected not to participate in the Main Street Lending Program. Instead, they confirmed that their primary regulator had no issues with the bank utilizing the 1 and 2 year deferral of interest and principal feature utilized by the program and the bank's regular lending program. This will help provide certain qualified pandemic-affected borrowers the liquidity they need. Accordingly, it may be helpful to coordinate with the appropriate regulators as to whether this type of regulatory action might encourage other banks to similarly modify their lending programs to assist affected borrowers. Thank you again for the opportunity to speak to you today, and I look forward to your questions.
Thank you, Mr. Foster. And now, Ms. Mills, you're recognized for 5 minutes.
Thank you, members of the commission. My name is Gwen Mills. I'm Secretary Treasurer of the Hospitality Union Unite here. While I will focus on our members' experiences, the recommendations I make are supported by the AFL-CIO, representing 55 national unions and 12 million workers. Our 300,000 members work primarily in hotel, casino, food service, and airline catering industries, all sectors that are heavily dependent upon travel and tourism. Before the CARES Act became law, 90% of our members were laid off. Today, 85% remain unemployed. A majority of our members are women and people of color. Many are recent immigrants. Most have lost or will soon lose their health care. Benefits won, often, after giving up wage increases to secure family health care. Hundreds of our members or their families have died from coronavirus, 22 in Las Vegas alone, where 350 have been hospitalized. Our industries are the most severely affected in terms of unemployment. So I believe our story is a cautionary tale of what awaits American workers across the board if we fail to correct course. At heart is the question of requiring employers to maintain employment as a condition of federal assistance. The Main Street Lending Program requires only commercially reasonable efforts to maintain employees in spite of clear congressional intent. Treasury and the Federal Reserve said they will not enforce even that. We've seen this movie before, and we know how it ends for working people. We've seen how powerful lobbyists transform the Paycheck Protection and Payroll Support programs into subsidies for real estate investors. We've identified 200 outlets where we have members that receive PPP loans, and they haven't protected paychecks or healthcare. One company, Omni Hotels, received 34 PPP loans worth at least $53 million. Meanwhile, Omni Hotels in Boston, Providence, and New Haven were shut down in March, and it is unclear when they will reopen. In Providence, the company then cut off medical benefits in violation of their union agreement. And there are many similar stories. What they reveal is how a powerful industry turned a program designed to keep workers on payroll into one that could keep hotel owners current on their mortgages. The Main Street program will yield even worse results for workers if this mission drift is allowed. Now, hotels demand a bailout of $86 billion worth of CMBS loans using the Main Street program. This commission reported that the Fed has considered establishing an asset-based lending facility that we fear would do just that. Who would benefit most from a hotel CMBS bailout? Lobbyists want you to believe it would be mom and pop hotels, but the largest beneficiaries are sophisticated real estate investors. Our analysis of loan data finds that the 11 largest borrowers had at least $1 billion each in hotel CMBS. Those 11 had a combined $30 billion in loan balances, or about a third of the total outstanding. 4 were private equity firms, 2 REITs, 1 a hedge fund billionaire, and the rest were developers or billionaire investors. The 12th belonged to the Fontainebleau Miami Beach, whose owner refinanced its debt twice in 2 years, borrowing more to cash out millions. Now, Fontainebleau has stopped healthcare for hundreds of laid-off employees, despite subsidies provided by the Employee Retention Tax Credit. Lobbyists claim if the Fed doesn't rescue CMBS borrowers, hotels will default and workers won't have jobs to come back to. But that is not our experience, and this isn't the first time hotel owners got themselves in trouble using these inflexible loans. After the financial crisis, there were scores of defaults across the country, but defaults and foreclosures didn't lead to closed hotels. Hotel workers who are used to seeing absentee owners come and go understand that jobs are driven by occupancy, and only ending the pandemic can fix that. Almost half of hotel CMBS mortgages mature within 2 years, before the industry is projected to recover. Should the Fed refinance the entire hotel lending market while real estate investors lay off 85% of hotel workers and end their healthcare in a pandemic? There is a second critical lesson here which relates to the Main Street program. There is no question that stabilizing credit markets is extremely important in a crisis, and the Fed has done that. But the real mission should be to protect jobs of American workers. The exclusive focus on markets and not on jobs means our members, most of whom are brown and black, are thrown off payrolls, while their employers, whose boards and shareholders are predominantly white, can simply tap their credit lines and ride out the crisis. It is no longer acceptable for the Fed to just stand by and watch us fall off a fiscal cliff. Millions of American workers are right behind us on the precipice. Instead, what if program designers at the Fed take the CARES Act mandate to heart? What if credit terms were loosened, so long as, and here's the important part, so long as there were airtight requirements, not incentives, not recommendations, but requirements that recipients keep workers on payroll. It is what the PPP could have done if it hadn't been hijacked by the real estate industry. The Fed and Treasury must learn from PPP and reform Main Street lending so that it actually contributes to the employment of working Americans. But please don't bail out real estate investors while they push workers off the cliff. Thank you for this opportunity, and I welcome your questions.
Thank you, Ms. Mills. Appreciate your testimony today. We'll now have a round of questioning, and I recognize myself for 5 minutes. Let's start with Ms. Anderson. You were talking about your view of the banks taking up of these loans and what modifications might be made for less than credit-worthy borrowers. I understood that point. But as I said in my earlier questioning, 5,000 banks jumped on the opportunity to help in the PPP environment under the CARES Act, and we've got very few banks that are engaging here. What is the Bank Policy Institute doing to promote banks participating in the Main Street program?
Thank you for your question. In terms of BPI member banks, the vast majority of our members are participating in the program. I can't speak obviously for all banks across the country, but I think when you think about the complexity of the program, it's difficult not just for small borrowers, but also for smaller lenders. The program is set up as a participation structure, which is typically used in the syndicated loan market. Many smaller banks may not actually be active in that space, familiar with it, and there is quite a lot in terms of going through the legal documentation and setting up the infrastructure to actually lend in that manner and comply with the terms of the program. So while we certainly have our members participating, it may be more challenging for smaller banks.
Thank you. And do you agree with the testimony on our panel that it's possible to make a very credit-worthy loan that's not based on the EBITDA multiples and the senior nature of the term sheet? In other words, that if one were to have sufficient collateral coverage and a 125 debt service coverage ratio, but a junior lien, wouldn't that be considered a credit-worthy loan as well?
So a number of our members have said that they would be interested possibly in lending in a junior facility, something that's collateralized. I think it would be up to the Fed and the Treasury to decide exactly what their risk appetite would be in such a structure and structure the terms appropriately. So it may not be 1.2, but something similar. So yes, I do think banks would be interested if there was a junior facility available.
Do you think the Fed and the Treasury are not setting the risk parameters appropriately in their existing Main Street term sheets? In other words, are they too strict? Are they too much like a traditional senior bank loan with not even a step in the direction towards a slightly distressed solvent, a creditworthy, but temporarily distressed borrower?
So I think the eligibility criteria that the Fed and the Treasury established probably fit the program that they set out to design, as President Rosengren said, in terms of a liquidity program. But there is a key element. So even if you reduced some of the stringency of those terms, you still have the underwriting element. And in this environment, underwriting on today's information will be difficult for many borrowers in that distressed space. So I'm not sure that actually loosening the criteria is necessarily the right answer. But I think also in terms of what President Rosengren said, if companies really need equity, then a Federal Reserve lending program is not the right solution for them.
Understood. Thank you for your response. Mr. Bond, let's talk about the affiliation rules. You heard my conversation with Dr. Rosengren that the Fed here in the Main Street facility has adopted those Small Business Administration 7A lending affiliation limitations for this middle market of non-super small businesses and certainly those not eligible to raise capital in the public markets. Are those affiliation rules a serious impediment, and can you give us an example?
Thank you, Congressman French. I think that what we're seeing and hearing and what was evident in the survey that we had is that these businesses were originally excluded from the PPP, and there was hope initially that in the Main Street lending provision that there would be opportunities for them to utilize benefits and lending from Main Street in order to not only keep jobs, but also invest in some of the changes that they need to do as people start to pivot based on the economy, and whether that is setting up plexiglass and rearranging their buildings, or whether or not that's related to simply doing business in a much different way. But we have heard from them loud and clear that their inability to access them has had a significant impact on their business. When we first went out there and talked to our members. Yep.
Yeah, thank you for that. We'll have another round, but my time's expired. Let me turn to Mr. Ramamurti for 5 minutes.
Thank you, Mr. Chairman. And thank you, Ms. Mills, for your testimony today. You noted in your written testimony that hundreds of your union's members and family members have died from COVID, and many more have been hospitalized. I just want to extend my condolences to them and their families and to you. And I think it's a powerful reminder that this is first and foremost a health crisis, and that frontline workers like the people that you represent are bearing the brunt of it. You represent a lot of people who work in hospitality and in tourism as frontline service workers, hotel housekeeping, bellmen, wait staff, cooks, bartenders, casino workers. You mentioned in your opening statement that a majority of your members are people of color and that a majority are women. When the companies who employ your members struggle, who are the first people to suffer via layoffs or furloughs?
Thank you for your question. Across the board, it's the frontline workers first, our members who are laid off, and
Right.
our experience is that the white middle management are able to keep their jobs.
And when they are laid off or furloughed, it's not just lost income, right? In many cases, they're losing access to health care, to retirement contributions, and to other benefits.
Absolutely, yes.
And so among the hundreds of thousands of travel and tourism industry workers that you represent, 4 months into this crisis, are you aware of a single job that has been saved by the Main Street program, or even a single hours cut or furlough that the Main Street program has stopped?
No.
And as the Main Street program is currently designed, do you think it will help workers in the future, even if more companies participate in it?
No, as I said in my testimony, not without binding requirements that employees be rehired from the first day of the aid.
Right. So in other words, even if a lot of companies end up getting loans through this program, you don't think that the benefits of those loans will flow through to workers?
No, not without binding requirements.
So 45 million people work at companies that are eligible for the Main Street program. If the goal is to help those millions of workers, do you think the Fed can just make tweaks to the Main Street program to achieve that, or do you think Congress needs to come up with a brand new approach?
In this case, I don't think tweaks will work. I think Congress does need to come up with a new approach.
So let's talk about that a little bit. In your experience, what kind of new approach do you think would be helpful to your workers? In your experience and the experience of your members, does providing financial support to businesses help workers without express and enforceable requirements that businesses actually use that aid to support workers?
No, time and again in many different programs without enforceable requirements, support to businesses doesn't help workers.
So of the $500 billion that Congress gave to the Treasury in the CARES Act in March, there's currently more than $200 billion sitting unused and uncommitted. If you were to use that money to develop a program that would be most helpful to your members, what would you do with it?
The two things that matter are healthcare and wages. So we would fund COBRA payments so that we could continue healthcare, and then give direct support to workers.
And thank you. And one final question about this. Did the Treasury Department ever reach out to your union as it was designing this lending program that was ostensibly about helping workers?
No.
Thank you, Ms. Mills. Look, I share your views, and frankly, I think it's time we started to listen to working people, not executives and investors and their lobbyists, when we design these programs that are supposed to be ultimately about helping workers. Thank you, Mr. Chairman. I yield back.
Thank you.
Thank you, Mr. Ramamurti. Congresswoman Shalala is recognized for 5 minutes.
Thank you. Let me follow up with Ms. Mills, since I represent a district that has a huge number of workers that work in the tourism industry, particularly in the hotels, including the Fontainebleau, which you mentioned. We had a debate with the Fed over whether their term commercially reasonable was better than reasonable. But it sounds to me from what you've said that either one does not mandate that these programs keep people employed, or even furlough workers keeping their health care so that they can get on unemployment and keep their health care. I take it that we'd have to really fine tune that requirement in these programs to make a difference for the workers that Unite represents, but the thousands of workers that work in this industry.
Yes, thank you, Congresswoman, for your question. I mean, our great concern about the Main Street Lending Program is that the hotel industry is seeking changes so that they can use the program to pay their CMBS mortgages. Like there's a $975 million loan at the Fontainebleau, Miami Beach, that's in your district. As I mentioned, the Fontainebleau stopped paying healthcare for hundreds of our laid-off members, which we believe is in violation of our contract. And so it would be wrong for taxpayers to fund a year or two worth of Fontainebleau's debt payments at $39 million a year, while laid-off workers lose their health insurance and rely on the public hospital system. So fine-tuning, absolutely, requirements would be necessary. And I really appreciate your question today because one of those Fontainebleau workers died this morning of COVID in the hospital without his medical or life insurance.
Yeah, I heard that, and I am so sorry. I want to point out that those workers are also taxpayers because
Yes.
we're talking about their money being used for the mortgage payments. So you don't see anything in the Main Street program that could be significantly improved unless it was totally restructured in terms of helping workers in this country.
I think that's right. It would need to be restructured with requirements off the bat for bringing workers back as soon as any assistance was issued. Yes.
Well, thank you very much. Let me ask Ms. Anderson a question. The Main Street Lending Program allows banks to employ their own underwriting standards to loan applications. Does that mean that banks are making loans under the program that they would have made anyway, absent the Fed program? And if so, is the Main Street Lending Program providing any benefit to borrowers at all?
Thank you for your question. In terms of the loans that are being made, I think they're quite specific in terms of the circumstances, because you're absolutely right. A borrower who can meet a bank's basic underwriting standards is typically finding out that there is a product that is more suited to them given their credit needs. So for example, maybe a term loan really is not what they need, and they really need something more like a flexible working capital facility. So our banks are actually many times finding better solutions for these borrowers when they inquire about the program. In terms of the live cases that look like they might go through, one example is a travel company that basically came to one of our banks as a new lender, a new borrower, sorry. And the bank would be comfortable possibly lending the 5%. And in a normal circumstance, they would go out and syndicate that loan to the market. But given the timing that it takes to do that and the need to actually get finances to these borrowers, that's one where they think it makes sense to use Main Street because the government is there ready and waiting, so they don't have to go through a syndication process. But you know, whether there are lots of borrowers in those specific circumstances, I think is questionable.
One more quick question. Many of the small to mid-sized businesses that were able to get by in the first few months, they used the PPP program and now at the end of their ropes. Goldman Sachs reported that more than 80% will be out of PPP money. If that's the case, where are they turning for funding? Are your banks seeing an uptick in loan requests?
I wouldn't say we're seeing a huge uptick in loan requests, but something that is interesting is that the vast majority, so probably over 70% of new borrower inquiries that our banks are getting are actually borrowers who think Main Street is a PPP program. So they think it is a loan forgiveness program or a grant program. And once they hear the details, then they realize it's actually not for them. So they are looking for something that is equivalent to a PPP type structure.
Thank you.
I yield back.
Yes, thank you, Congresswoman Shalala. Your time's expired. Now we'll turn to Senator Toomey for 5 minutes.
Thank you, Mr. Chairman. I just want to go back and review very briefly a little bit of the history about how these programs came together. Because we debated the extent to which we should have mandates to retain a workforce and how best to do that. And for small businesses, we thought that, it might be possible for businesses, even businesses that are essentially closed, have no business, it might be possible to maintain their payroll if we paid for it, if we had the taxpayers pay for it. And so that's what the PPP program was designed to do, take a finite period of time and have the taxpayer just pick up the tab for the payroll. And to a very significant degree, I think it's worked. And it was probably necessary. With the Main Street lending program, the idea was that these would be loans. And while obviously everybody wants to maximize employment opportunities, maximize jobs, we're all celebrating record low unemployment, record high job opportunities for everybody in America, most especially African-American community, Hispanic community, people who have historically had higher rates of unemployment. We're seeing tremendous gains. This was all great. But the idea that we would require companies to borrow money for the purpose of maintaining a payroll for people who they didn't have work for because the business was closed, that didn't seem to make sense, which is why we made unemployment benefits more generous. We did direct payments of $1,200 to everyone to offset the lost income that was inevitable. So let me try to illustrate this another way with a question. Maybe Mr. Bone or Mr. Foster would want to take a shot at this. If a business is losing money, probably massively, has a collapse in sales, has no orders coming in because of this contraction that was underway and hopefully is in the process of getting behind us, and therefore has no work for its workers, if that business goes out and borrows a lot of money to pay those workers anyway, does that make that business more viable, more likely to succeed, more likely to be there at the end of this contraction to be able to bring workers back?
Well, Senator Toomey, thank you. So if I could, I'll take a stab at that. I think what we're talking about here is really two separate things. I think, yes, PPP was definitely designed to save jobs in the immediate term and as quickly as possible. What we are hearing and seeing from middle market organizations, though, is that the loans, if they were able to get them, would go to investment in opportunities that would create jobs or bring back jobs within their company. So if you even use the example of ACG as an organization, there's a lot we have to do and don't have the finances to be able to really exist well equipped in this new virtual environment. We're seeing that time and time again, whether it's for our restaurants and how they're having to handle how they prepare for orders and utilize technology. So there are opportunities, but at the end of the day, it's a moot point because there's such a large number of them who are not able to access the program overall.
Thank you. Mr. Foster, do you have a comment on this?
Yeah, I mean, I think that the main thing right now is for the type of business that you illustrated is to keep the business. The business is in survival mode. Can you hear me? Great. And you need to let the business owner do what's necessary with the capital to keep the business alive. Certainly, payroll is a part of it, but frequently they're behind on lease payments and they could lose their facility. They've stretched their suppliers. You just have to leave it up to the business owner because they're in survival mode.
Let me ask a question for Ms. Anderson. My understanding is that the federal bank supervisors have made it clear that they will treat the Main Street lending loans in a manner consistent with their supervisory approach to other commercial and industrial loans. So here's my question. If they were to change that and they were to take a less restrictive view in their supervisory capacity, would bank behavior be likely to change, or is bank behavior is so driven by the existing set of internal rules that it would be unlikely to change?
Thank you. So some bank behavior might change, but it may not be actually the behavior that is desirable overall. I think one thing to be clear is we don't think it's appropriate to have supervisory forbearance. A transmission of risk from the corporate sector to the banking sector is really not in the best interest of anyone. And certainly if you ask banks to go and make riskier loans right now, it might be okay for 12 months, but the credit problem will still be there just down the road. So I think banks basically are looking at that, and even where supervisory requirements were relaxed somewhat, I think they can see that it is not worthwhile to rack up bad loans on their balance sheet that they will have to basically work out at some point in the future.
Thank you, Ms. Anderson. Senator Toomey, your time has expired. The gentleman yields back. We now have a second round of questioning for this panel, and I'll yield myself 5 minutes to start that. I was looking, some of these questions we're faced with today, and that the Fed and the Treasury are faced with are not new questions. I would like to read a quote. If it's a pawn shop in which necessitates borrowers are compelled to hock assets worth 2 or 3 times the amount of the loan, we are opposed, and we think most business people will be as well. We see no reason why the government should be engaged in a careful pawnbrokering enterprise, niggling over security, haggling over interest, and competing with other lenders. That was written back in 1933 as the Reconstruction Finance Corporation and the Fed struggled with how to get credit out to the American marketplace in a very tough economic recession of the 1930s. And I think we're dealing with that issue now in this middle market segment that we're talking about today. And Mr. Foster, you offered some very good constructive comments on specific loan term changes, but can you also address the affiliation question that I posed earlier?
Sure. Let me try to do that by giving you an example. So, and I want to compare and contrast to a triple P. So in triple P, which use the same 7A program affiliation rules with relaxation for companies with an SBIC investment, hospitality industries, franchises, et cetera. So you don't even have that in Main Street. So in triple P, if you had 2 commonly owned businesses that had 200 employees each, and they each had, say 20 million in pre-existing debt, they could each access $10 million of triple P for a total of 20. They needed to have the requisite cost structure to be able to do that. You switch over to Main Street, 2 companies under common control, 7,000 employees each with 20 million in pre-existing debt, 14,000 employees. They have to share, if one of them wants to do the new loan facility, they have to share $15 million in total assistance under that program. And it really doesn't make any sense where from an employee perspective, you got 14,000 employees that have access in total to a $15 million loan versus under triple P, you had 400 employees that had access to up to 20. So it really is poorly designed, and it doesn't make any sense for these kind of companies to have to run through really complicated and really severe 7A regulations that are really focused on making sure companies with more than 500 employees don't have access to a 7A loan.
Thank you. That's helpful. I appreciate that example. Ms. Mills, let me turn to you and first echo my comments of our fellow commissioners about condolences. So many of our families across the country have really suffered in this pandemic. We have to remember when we're doing our oversight work that first and foremost, this is a public health crisis that's led to an extraordinary economic crisis. And so I appreciate the comments you made and the care you have for all of your members and your advocacy today. And I also agree with Senator Toomey that the Main Street program is not the solution to all challenges in this pandemic either, and that's why we have the unemployment compensation, the direct payments to our families, the forbearance in mortgage and rental payments, the payment for leave, the payment for testing, the flexible furlough program in the state so that people can be furloughed, maintain some benefits, and get unemployment compensation, and obviously the aforementioned PPP. So all these federal policies work together to try to minimize the impact on our families and help them get through the pandemic and also help get our economy back to full capacity. In looking at your testimony, though, 74% of CMBS are less than $20 million. And in my district, Asian American hotel owners are the classic small business entrepreneurs. And as I understand it, over 50% of hotel rooms are owned by these kinds of classic small business entrepreneurs across the country. And they're worried about getting October property tax payments in Arkansas, as I know one of their concerns, because they want to bring their staff back. They want to bring their staff back commensurate with the economy reopening. And also, owners of CMBS securities are mostly pension funds and people's retirement accounts. And so they're all benefited by trying to get capital into the industry and get people hired back and reopened. So I'm empathetic to your testimony. I thank you for being here very much and for your comments. But I think that the Main Street program's mission is to try to get our hotel and hospitality open, and I hope we can find a structure that does that. Let me yield back and turn to my friend, Mr. Ramamurthy, for 5 minutes.
Thank you, Mr. Chairman. Mr. Bond, thank you for your testimony as well. I want to ask you the same type of questions that I asked Ms. Mills earlier. You come at this from a different perspective. You run a mid-sized company. Your organization represents a lot of such companies, but you seem to agree with Ms. Mills that this program hasn't been helpful so far. In fact, not a single one of your member companies has actually been helped by the Main Street program so far. Is that right?
That is correct.
And it's in your testimony that the program needs to be changed. Can you describe the kinds of ideas you have in mind for that?
Yeah, we list a couple of ideas in there that start with the removal of the affiliate exclusion, reducing the EBITDA requirements to make it more appealing to a broader class, particularly in the lower middle market. And we also talk specifically about the loan size and bringing the loan size down even further. Those are just some of them that we think. And again, this is not only our team internally talking, this is the direct comments we received back in the survey we just did.
You also mentioned eliminating the restrictions on shareholder payouts and on executive compensation. Is that right?
Correct.
So look, I agree with you on the diagnosis here, which is that the Main Street program hasn't really helped anybody so far very much, and it's also unlikely to help a lot more companies without significant changes. But I'm concerned about the proposed solution that you're offering. You propose changing the rules so that every company can get a loan, even if before the crisis they had a lot more debt than they had earnings. In other words, no matter how much risk there is that the public is going to end up holding the bag at the end of this. And at the same time, you propose eliminating restrictions on companies spending the loan money on payments to their shareholders and eliminating restrictions on executive pay. So I guess my question is, why should the American people be willing to give billions of dollars to potentially failing companies that can just use that money to pay shareholders and executives while firing workers?
Well, I think Commissioner Ramamurthy, when we talked about things like EBITDA and whether or not the company was at a higher risk prior, if you consider a large part of the lower middle market, which are oftentimes family-owned businesses, EBITDA can be in that case can be a misleading indicator because a lot of the costs and expenses roll through salaries and other types of things. And at the end of the day, the EBITDA is not something significant. We see this a lot of times when purchases and acquisitions are made, where there's a lot of debate and discussion over EBITDA and what is published through their regular financials. So I think when we are looking at that, we tend to eliminate the opportunity for companies, particularly family-owned companies who are in that lower middle market, who at the end of the day, their margins, their EBITDA are very, very limited and small, but yet they've been very successful for years, employ a number of different people.
So can I ask just a follow-up question on that, let's say the executive compensation restriction specifically? If a company exists that is not interested in the Main Street program because of the executive compensation restriction, isn't it a fair guess to say that the reason that they are not interested is because they want to use some of that money to increase executive compensation? Otherwise, why is that a deterrent to them?
Well, again, so that particular comment comes directly from some of our members of why they're not interested, what their particular reason for not being interested. I can't go to that intent, but I will say that if there is anything that limits their ability to eventually sell the company upon paying the loan or to derive the benefits that they have built for building a company over time, I think that that's going to absolutely preclude them from wanting to utilize the funds that could otherwise be available to them.
Thanks. Look, I think, just to sum up quickly, I think we've actually seen a remarkable consensus emerge at this hearing, which is that the Main Street program as currently designed is failing. And the representative of the banking industry told us that we aren't seeing meaningful demand for loans right now from their clients. The representative of small and mid-sized businesses told us that the program wouldn't help his members as currently designed. And Ms. Mills, representing hundreds of thousands of workers, told us that the Main Street program hasn't helped a single worker and isn't likely to. I don't question the hard work of President Rosengren and the Fed staff, but more loans are not going to solve this crisis. Struggling small and mid-sized companies can't take on more debt right now, so the only tool in the Fed's belt is the wrong one. This program was given $75 billion and months to succeed. It didn't, and it can't. It's time to stop tinkering around the edges with adjustments to loan eligibility and loan terms when the fundamental problem is with the nature of the loans themselves. It's time for Congress to step back in so that we can actually save small and mid-sized businesses. And when it does, it needs to tie the assistance to meaningful, enforceable protections for workers and not just hand money to executives and trust them to take care of workers' interests. Thank you, Mr. Chairman.
The gentleman yields back, and we now turn to Congresswoman Shalala for 5 minutes.
Thank you very much. Ms. Mills, one of the problems with the loan program, it seems to me, including this program, which clearly has flaws in it, is that loans protect the health care of executives, but not of workers. Nothing that we've done, unemployment insurance to support workers, protects their health care. Unless these hotels, for example, furlough people and keep their health care. So fundamentally, what the Fed has done will protect the health care of a lot of executives, but there's nothing that we've done, particularly in the unemployment insurance system, that protects the workers' health care. I think that was one of your points.
Yes, thank you. That is correct, that the extension of the wages that the Congressman mentioned has been appreciated, although it is now ending. That is problematic. But there has not been an extension of healthcare. So, and even in a case where we have some healthcare negotiated, companies like the Fontainebleau can, are not abiding by that. So that is absolutely correct.
Anderson, 3 of the 5 facilities required that Main Street loans be senior or pari passu with in terms of priority and security the borrower's other loans or debt instruments other than mortgage debt. Are lenders willing to subordinate or dilute their priority and security? What impact does this provision have on applicants' ability to borrow under the Main Street lending program?
Thank you for your question. This is a true issue in the sense that many mid-sized companies have existing debt structures, and having senior credit come in at this point basically has to be negotiated with those existing lenders, many of whom are not bank lenders, and that then becomes a complex process in terms of an intercreditor agreement. And I know that has certainly put off some borrowers in terms of trying to go through that process when they may not receive the consents from the other lenders who may just not have the same incentives as the originating bank. So it is a problem, and it is complex.
Thank you. I have a question for Mr. Bourne. In your written testimony, you stated that the challenges with the Main Street lending program have a lot to do with whether people actually understand it. Do you have some specific recommendations in that regard?
Thank you, Congressman Shalala. And as I'm sitting here in Orlando, Florida, thank you for representing our great state here on the commission and in general. Yes, I think that one of the things we heard back from our survey was that there was, unlike the PPP, where there was significant awareness about the various provisions and tenets of it, there was a lot more ambiguity and misunderstanding. Some of that related to how long it has taken for the program to come together. Some of that because there was a little bit of misunderstanding, thinking that it would be different than PPP because it was loans and not carve out 501c6s or affiliated groups. So I think that there's a opportunity here, regardless of where the changes are made, to make sure that the program is much more clearly communicated on a wider basis. And we're certainly willing and able to help with that in any way we can.
Do you have a specific recommendation on the loan size and the leverage test?
Well, I have a specific recommendation on the loan size that it should come down to closer to $50,000. And here's what makes me say that. There are a number of smaller family-owned businesses in the middle market that I've spoken to recently right here in Orlando who have said, look, we do not need 250,000, but we do need 50,000 or 75,000 in order to prepare what we think is going to be a longer haul to deal with the fallout from COVID, whether that's safety equipment or how we run our operation. But 250,000 is too large of a haul for them. And again, don't wanting to get out over their skis financially. So yes, a specific recommendation on that. Yes, ma'am.
Thank you. I yield back.
Thank you, Congresswoman. And now we'll yield to Senator Toomey for 5 minutes.
Thank you very much, Mr. Chairman. This has been very, very helpful and informative, and I really appreciate the testimony of all of the participants. My own view is it's way premature to come to the conclusion that this has all been a failure. Okay, I think there are definitely some improvements we ought to be looking at, and there might be entire new versions of Main Street programs that we ought to contemplate. We talked about affiliation rules, which I think need to be changed. There may be terms that ought to be modified. I am interested in something that would be more asset-based rather than just income-based. But let's keep in mind, it took a long time to get this up and running. That was always going to be the case because of the nature of the complexity of doing this kind of lending. There has been a recent acceleration in use. If the acceleration continues, we may see significant pickup. Mr. Bone makes the argument that there is a high level of unawareness or low level of awareness about this. There's a lot we could do to remedy that, which could result in more participation. And then finally, this leads to my question. I would argue that the corporate bond programs, which are not the ones we're here to talk about today, but the 13-3 facilities that set up the corporate bond buying programs have been enormously successful, despite the fact that the Fed has purchased very, very few bonds. It was the standing up of the program, the existence of the program, that allowed the private market to operate actually at an all-time record volume after having been frozen. That's a remarkable success story, despite the fact that there was not a lot of use. So that gets me to my question. And maybe I should have asked this at the beginning, but Ms. Anderson or Mr. Bone or Mr. Foster, and any of you might have a thought on this, but how should we best determine objectively the extent to which credit needs are being met or not being met? I have heard anecdotally from Pennsylvania companies and Pennsylvania banks that when this pandemic resulted in a shutdown, there was a massive drawdown on existing credit lines. People piled up as much liquidity as they possibly could, that then after a little time passed, they started to pay down some of those balances. But we can certainly see bankruptcy filings. At that point, it's kind of too late. What should we be looking at on a day-to-day basis? What metrics should we be using to determine how significant the unmet credit demands are in this space? And Ms. Anderson, maybe you could lead it off.
Sure, thank you. So I think you make a good point in that by and large, credit demands for many companies are being met. I mean, we saw record lending from banks early on in the pandemic. So $700 billion plus was lent over the course of 3 months. Since then, we have seen about $200 billion in that C&I lending space be repaid. So I think you're right. Businesses are, paying down some of that liquidity that they took in the early days of the crisis. In speaking to our banks, I mean, the demand for credit has lessened. They're not getting millions of inquiries from their customers, new or existing. And I think that really says something. And they've all been segmenting their books, trying to see who needs credit or other solutions. And if it really is a temporary liquidity credit need, then the banks by and large are providing that. If it's a solvency need, that is not something that banks provide to companies.
Senator, I think one simple way to figure out if there's unmet credit needs is to ask the banks how many Main Street loans have been requested by borrowers that the banks have rejected. If you could capture that data, you get a real good idea, because I'm aware of probably 100. And it's not the bank's fault. We have a restaurant group in Florida, and the bank who signed up for the program said, I can't take any more restaurant exposure in my portfolio, because they're approaching it like a bank. They're not approaching it differently. They're not relaxing their underwriting standards. You're a restaurant group, you're not getting a bank loan. And if we can capture that data, you'd figure it out.
I think that's a very interesting point. Ms. Anderson, is there a way that data is being collected systematically so that we could access that, or does that not exist in a centralized place?
So it's not being collected systematically at this point in time. Certainly, we could work with our members to get you additional data on that. In terms of our members who are active in the program, they're receiving between 500 to maybe 2,000 inquiries in relation to the Main Street Loan Program. And as I said before, upwards of 3/4 of those actually don't understand the program and think it's a grant program. So it's really not a high level of inquiries even.
Thanks very much, Mr. Chairman. I see my time has expired.
I want to thank our witnesses again, both panels. Excellent discussion. I want to thank our commissioners for their participation today and for their thoughtful questions. And on behalf of the commission, in addition to thanking the witnesses, let's thank the staff as well for their preparation in putting the hearing together. This hearing is adjourned.